For the initial rates, it seems like we're able to do so. So 19,063 is the print that Nifty has started off with. Although I must add, it's absolutely flat when it comes to an index move. Reliance, let's revisit what that stock is up to after its numbers, which were largely in line. Of course, a beat when it came to individual segments like retail, 1% higher for Reliance Industries as we speak right now. For Dr. Reddy's too, it's been an inline set. So let's just revisit what that stock is doing, though that's down about almost 3%. Cipla numbers were good, Maruti numbers were good, SBI Life, BPCL, Bajaj Finserv was actually in line, but the rest of the numbers turned out to be quite okay and good. Lots of earnings this week. Tata Consumer, L&T, Bharti all report their numbers tomorrow. Then day after, you've got Sun Pharma, you've got Hero MotoCorp, you've got Tata Steel, Britannia. And then, of course, on 2nd November, you've got Tata Motors and Adani Enterprises as well delivering their numbers. So extremely earnings heavy. But I want to check in on what some of the newsmakers are up to. And let's start off with what AU Small Finance Bank is currently doing in trade. That stock will just come up for you on your screens, considering that's the newsmaker really this morning. Remember, the company is looking to acquire Fincare Small Finance Bank. AU Small starts off in the red, 1.6% lower. There's Gujarat Gas as well, wherein the company has announced an increase in the industrial gas prices by almost 2.3 per standard cubic meter. So that's quite a bit of a jump. There's Ultratech Cement as well, wherein the board has approved a capex of 13,000 crore rupees to up their capacity. IFL Finance, wherein Jefferies is initiating a buy with a target price of 760. There's IRB Infra after getting that letter of award from NHAI. That stock as well has gapped up. Dr. Reddy's, of course, more than the earnings, it's the US FDA issuing the Form 483 with 10 observations for their manufacturing unit in Hyderabad. That's really impacting the stock, 1% lower as we speak on DRL. Meantime, there's also NTPC. The numbers have been in line with estimates. Margins have come in 25.7. So that's something that should go down well with the street. Even Inox Wind, wherein the losses have now narrowed both on a year-on-year as well as a sequential basis. The EBITDA has jumped into profit versus loss on a year-on-year basis right now. Route Mobile, the margins have come in at 12.6%. EBITDA is showing an uptick of nearly 24.5%. Oberoi Realty, good numbers there. Revenue uptick of nearly 77%. Margins have expanded to 52.4%. 1% higher on that stock. There's Greenlam as well. That's another stock which is in focus. The EBITDA has come up higher by 40.8%. And the margins as well have expanded to 12.5%. Piramal Pharma has been actually quite the beat. So the margins have jumped up all the way to 14% versus 10%, and it's a net profit versus loss on a year-on-year basis. Piramal Pharma has gapped up about 6% as we speak right now. There's AU Small Finance Bank came out with its numbers too. Besides, of course, the news with Fincare SFB, the NI has shown an uptick of 15.5%. MGL2 Q2 volumes, they've come in higher by about 3%. Revenues higher by 2%. So these are a couple of stocks which are reacting in the positive. But BPCL, the numbers, while the numbers were above estimates, the GRMs haven't quite matched up to what the street was anticipating. SBI Cards, M&M Finance, Blue Dart have all been a bit of a disappointment by way of earnings. But Naresh, it's a nothing sort of start for the index. Stability, yes, and Reliance holding up. What's your take, A, on where the market is headed next? And of course, any stocks that look interesting to trade?
So overall, continue to remain range bound is the view. 18,850 should hold for the day. 19,100 on the upper end. Overall, could be a time to just watch it out. Not really looking at taking a trade as of now, unless we start getting into a sharper momentum above 19,100, 200. So for now, time to just watch it.
All right, that's the view coming in from the chartist, but time to bring on board Vikas Khemani now, who's joining in, founder at Carnelian Asset Management. Hi there, Vikas. Good morning. Good to have you on board. doesn't seem all that rosy when it comes to the global picture, and that in particular is perhaps what may be unnerving investors. Do you think that we have the capability to continue to, navigate our own course, stay isolated from all that's happening because recessionary fears, S&P entering a bear market territory, all that remains on top of mind when it comes to global markets?
I think, clearly, if you see the large part of the worry is coming from the global markets, global macro setup, and there's no answer to that. It will have to play out the way it is. And it is also wrong to say that one would not get at all impacted if something were to happen in the US and all. The only thing I think which gives the biggest amount of comfort is that whatever is pain elsewhere, India is not going through that. India is in one of the best growth phase. India's macros are very well placed, whether it is fiscal deficit or current account deficit, or India's interest rates is one of the lowest. If you see the interest share differential between the US 10-year and India 10-year. So, like I said, that whatever is a problem in the rest of the world, India either benefits from that or India is well placed from that. So, in that sense, India on a relative basis remains very well placed. And shorter term, there can be anything because there can be some bit of volatility as we are witnessing right now because of the chaotic global macro setup. But I'm sure as it settles down, whether it is 3 months, 2 months, 6 months, nobody knows. And India will again sort of stand out and do very well because there is no other market in the globe which can offer India's profile at this point in time, whether it is growth, macro stability, and governance and all counts, and which is from a medium term to long term perspective.
Because at an index level purely, we've fallen more than 1,000 points from the top, right? Do you believe that valuations are comfortable right now? And do you sense that there could be further correction perhaps from the lows that we tested last week?
I think the current correction has nothing to do, in my opinion, is not because of valuation. It is all because of the liquidity. We saw a decent amount of outflow happening in the markets from the foreigners, but of course there is good money which is coming from domestics. But typically we do not think markets are very expensive. Markets are in a fair value zone. In any markets valuation, there are, or in any asset class valuation, there are three things which goes, earnings, so ROE, earnings growth, and the discounting factor. If you look at all three, ROE is one of its best ever. On absolute basis, on a relative basis to emerging markets, our growth is again on absolute as well as the relative basis well placed. And discounting factor, our interest rates are one of the lowest, in a historical context. Risk premium is coming down. So I think if you see all these things, I don't think Indian markets are at all expensive. I do believe that as the global macro environment settles down, we will see markets getting further re-rated, and we will, see uptick of valuation from here where we are in times to come.
So when we look back, Vikas, would last week have been a ripe opportunity to buy? And is that what you did?
Yes, I think we've been nibbling in and I mean, again, we don't look at, to be very frank, at a market level and decide what to buy and all. We do look at the companies we like, businesses we like, managements we like, and a fair value or price range which we like, and around that we operate. So we've been, last week was a decent correction. Many of interesting opportunities were there. So we do act on that. And having said that, I'm not saying markets cannot fall further in a shorter term. Nobody can predict. 4-5% correction can be around the corner any point in time, whether you are at 19,000 Nifty or 18,000 Nifty or 20,000 Nifty. So that risk one always carries. But I'm quite confident that when you buy in uncertain times, when you buy in times when there is a chaos, as long as you are convinced about the long-term opportunity space and long-term setup of the market, they are always an opportunity rather than the risk.
Because when it comes to banks as a theme, and I know you've got a couple of private banks in there in your portfolio, but you've liked PSU banks as well, and you've gone on record saying that you do see them report about a 20% kind of ROE in the next 1 to 2 years. But tactically, would you say that perhaps private banks are better placed right now because of the valuation comfort?
Really, I think we have all along been very bullish on private sector bank. We continue to remain bullish. We recently, or about some time ago, we also believe that public sector banks offer a great opportunity given the fact that the ROE profile could be similar. Historically, public sector banks had three problems: asset quality, governance, and technology. And on all three counts, they were ceding market share to private sector bank. And if you see, all three have been systematically addressed in last couple of years. First, it was asset quality. Then, we saw governance getting addressed. Most of the MDs are coming from a very good track record, and also with a 3 to 5 year kind of tenor. And lastly, most PSU banks have spent serious amount of money on technology upgradation, so which puts them at par with private sector. So and most PSU banks are available at below book. So we see that there's a potential re-rating across the pack, especially ones which are run by good leadership and who invested into technology. So we think that there's a good possibility of delivering better returns in the private sector bank over in a medium term.
Because there's been so much fervor within the primary markets. Lots of companies as well have recently made their debuts. And it seems that the consensus is that valuations are very stretched or out of whack in some cases. Is that a theory that you would go with when it comes to some of the currently listed new age tech businesses or even the recent and upcoming IPOs?
And whenever there's a good environment in the market, it always leads to a flurry of IPOs. It is very, very natural. We've seen a very significant amount of IPO pipeline, as well as the promoter stake sales happening in the market. They are signs of course, indication that markets were getting stretched. So current correction in that to that extent is welcome. And I always say that when you look at IPO per se should not be looked at any differently than investing in an already listed company. Of course, there's a small bit of pop, but if the valuations are already stretched, then why to look at that? So we are very careful when we look at companies. We like to invest only in companies which are less euphoric, but or more importantly, I think which are solid management, solid businesses, and from a long-term perspective. In this kind of markets, the listing pops are generally we seek the least, and when the markets are stressed, those are also kind of very less available.
Sure. So, Vikas, where is it that you're finding value? I know we've discussed banks as a pocket, but where else would you recommend adding position on dips in the current market environment?
It's there across the board, like banks we've talked about. I think in power segment there's a new change happening in terms of growth driver. You could see significant some interesting ideas there. I mean there's no one specific thing I can say, but I think there is an opportunities available across spectrum. Consumer, I think some point in time, there are interesting ideas emerging when one can look at, one should be ready to sort of explore. We have not bought any consumer stocks in last 3-4 years, but we've been kind of now evaluating very closely that can there be an interesting play out there. So you keep looking at ideas, and but to be honest, right now I can tell you we are fully invested. I mean we have small 3-4% cash. It's not a lot. So we are not as worried about valuation. We are not as worried about the potential growth which India has to offer.
All right. What about really banking on the CapEx theme down the line, Vikas? How are you looking at really building up on, helping an investor build up on the manufacturing theme, as well as on the boost to infrastructure, etc., and really looking to capitalize on this space?
India is seeing a huge amount of capex across infrastructure, private sector capex, industrials. I mean, manufacturing, we are seeing massive capex happening. So, and that cycle is only accelerating. In power sector, we are beginning to see in the thermal power segment, we are beginning to see new hope coming through in terms of new line of capex. So now, earlier there were small capex, size capexes. Now we are beginning to see the new wave coming about in terms of the large scale capexes, and I do believe that that cycle will lead again with a huge amount of push. So you will see that playing out. So, and typically, you play through capital goods company, credit cycle happens, and we are well placed across all which are enabling the capex cycle. So we invested into manufacturing, which is doing capex. We are investing into capital goods company, which are enabling capexes. We are investing into banking, which are also to some extent providing both working capital as well as the term loan to the segment. So it's again what you are playing is the entire India transformation story, and you got to play in through a balanced basket. At some level, all of them get in some sense interconnected.
They sure do. Vikas, always good to have you on the show. Thanks for taking the time out. Let's hope for a better market week ahead. In the meantime, it slipped a little bit actually for the index. So we're no more in the green, but we're consolidating around 19,084. We'll take a very quick break on that note. When we come back, we'll chat with the Root Mobile management. With the market right here in 80 now, slipped a little bit, backs up the 19,000 mark for the Nifty spot. The future is still holding on to that mark, obviously. So while you've got support coming in from Reliance, which is up almost 2% on the futures, SBI Life, TechM, Maruti and Cipla are some of the names which are actually holding out in the green. That's not quite the case with the broader end of the market, and a large part of the Nifty as well. M&M, Bajaj Finance, Tata Motors, Axis Bank, L&T ahead of its numbers tomorrow, ITC, Tata Steel, they're all the beleaguered ones. And even with the broader end of the market, M&M Finance, SBI Card, India Mart, we're going to be chatting with the management in the due course. That stock is down 6%. IDFC First also down, and so is Coromandel. But let me welcome on board Rajdeep Gupta, the MD and CEO at Root Mobile, and talk about how their quarter went by. Rajdeep, good to have you on the show. Q2 has reasonably done well despite seasonal weakness, right? Post the first half growth of 26%. Are you confident of achieving higher end of your guidance? That's 20 to 25%?
Hi, good morning. Yes, we are indeed very much confident about the guidance which we have given to the market. And as per the traction we see from the current customer and the new customer, we will definitely achieve our target which we have given to the market.
You recently signed a deal with Vodafone Idea as well. Tell us what's the revenue potential here and from when will it start being accounted for?
So we are our late stage of deploying the firewall with Vodafone Idea right now, and we are looking forward to go live by month of December. And the overall deal value is about $100 million is what we expect, because based on our entire calculation, it can go over $100 million, but I think we are a little bit conservative while giving the guidance. So we believe that potential of $100 million revenue could come from this deal. And I think the firewall will go live by mid-December or early December.
Right. We understand you also signed up an agreement with one of the e-commerce giants as well. Tell us a little bit more about this.
So it's one of the largest e-commerce giant based out of the US, and we have signed not just for one country, we have signed for 10 countries. The India traffic is live now, and I think the other countries has been now already been tested, and we believe that within a few weeks we will start getting traffic for UK, Germany, Sri Lanka, and other destinations. And it's a huge potential, and we are very bullish about this customer and the kind of platform and the quality of services which we have. Based on this, we won this customer, and yes, the customer is live, and we are very happy, and we are serving them, and the customer is very happy with our services as well.
New visibility then, considering we are talking about the mightiest e-com giant here.
So I think I might not give the revenue potential because
Sure.
it's a very early stage. Probably based on the this Q3 numbers, we can definitely come back to you guys and let you know exact potential. But yes, as I can tell you right now, it's a huge volume and the revenue potential customer. And we are very focused with this particular customer to make sure that during this quarter, we get all the 10 countries which we have signed to flow through our platform. And that is a key priority for all of us right now at Root Mobile. But definitely by next quarter, I will quantify the whole yearly revenue potential.
A couple of deals also which I want some updates on. The Proximus deal firstly, and whether you're on track to complete it by Q4.
Yes, indeed. I think there is already a governance team has been formed between Proximus, Telesign, and Root Mobile, and we see a very good progress in that. And we believe that Q4 is definitely where we can close the deal, maybe by mid-Feb, based on the current speed. So yeah, I think everything is going smooth, and there's a proper team and there's a proper consultant involved in this particular deal, and they are doing fantastic job. And in both the team from Proximus and the Telesign also is aligned with our vision, and I think things are going in the right direction. So mid-Feb, we believe that this could be closed.
The other thing that I wanted to talk about, Telesign, when is it going to reflect on your books?
It's a good question. I think we are right now waiting for this deal to get consummated, and based on that, there is a lots of synergy we see between Telesign and Route Mobile. The potential of having the US customer base and to deliver in emerging market will start flowing once the deal is closed. Uh, you can just consider maybe the Q4 is the right time for to get the Telesign uh, upside into Route Mobile.
Right. Also, Rajdeep, I wanted to understand. Recently, there was an event from WhatsApp, right, where there was much aggression in business messaging. Tell me, how is Route Mobile unique from, say, a WhatsApp India? And also, for instance, Amazon sends messages on WhatsApp. So, what could be the impact of the same on Route?
So we are a partner with WhatsApp, so it's not that WhatsApp is doing everything alone. It's like the partners like us who support WhatsApp to win more customer. I think there are lots of development, lots of bot needs to be built. There are lots of a bespoke solution needs to be created for enterprises. And so end of the day, we are the partner with the WhatsApp, and if you see our new product growth year on year basis, we grew by almost 64%. And we believe that the new channel of communication like WhatsApp RCS is going to change the way people communicate with their end user. And I think WhatsApp is a great partner for us. And I think we are working very closely with WhatsApp to make sure we get more customer base in India and other markets. For us, it is not just one market where we work with WhatsApp. We have multiple regions where we work very closely with WhatsApp. And based on the current adoption ratio of WhatsApp, I think it's a great value proposition for customer, and we can definitely gain more. In terms of Amazon, I think the WhatsApp is now OTP or something, not OTP, actually it's alert messages. I think there are multiple use cases of Amazon which goes to, I think, a day on day basis. So we don't see any challenge of that, because maximum what we carry right now is a OTP, and we believe that volume is growing day by day. And now because of the Q3 is more of festive season, and we may get lots of OTP kind of request from all these e-commerce companies. So we don't see any challenge of WhatsApp sending those alert messages. But yes, we are a partner of WhatsApp, and we believe that we're working closely with WhatsApp may create more value for Root Mobile.
Okay, Rajdeep, seems like it's great going for you in the next few quarters too. Congratulations once again on a strong set of numbers.
Thank you.
Okay, on that note, we're going to take a very quick break. Come right back. We've got an exclusive chat with the management of Indian Hotels coming up next. Back with first trades right here at 80 now. Digested the earnings, got Reliance in. Well, that stock may be holding up about 1.5%. Hasn't quite managed to rescue the Nifty. So Reliance has made it to that 2,300 rupee per share mark. But look at the Nifty. Started off flat, and from there we've now drifted lower by a good 0.5% actually. 18,977. So backs up that 19K mark. The future's just about lingering around that mark actually. And by the way, we're almost heading for a 100-point decline, no less. So yeah, Cipla, BPCL, Reliance still holding out, but M&M, Tata Motors, Maruti, the autos are really weighing heavy right now. Hero MotoCorp as well, Bajaj Auto, they're all in the red as we speak right now. But not just that, you've got L&T ahead of its numbers this week, LTIM, Bajaj Finance, HDFC Life, Britannia also due to report its numbers this week. ITC is down 1%, Unilever is down. So these are stocks which are really weighing heavy on the markets right now. The breadth of the market as well has been weak actually from the word go, and even worse than what the benchmarks or the frontliners are up to. So while you do have spots of green for an MGL, SBI Life for instance, etc., M&M Finance is down 10%, SBI Card is down 8.5% right now. These stocks will just come off you on your screens because they're almost headed in for double-digit cuts for themselves. There you go, SBI Card down 7%, M&M Finance, that's down 10% right now. There's India Mart, which is down 7% after its earnings. AU Bank as well, which is down about almost 6%, and IDFC First too, by the way, down about 5%. But I'm going to hand it over to Nikunj. She's currently in conversation with Puneet Chatwal, the MD and CEO at the Indian Hotels Company.
Well, it's always a pleasure to interact with Mr. Chatwal to talk about which way the hotel industry is moving, the future of Indian hotels, and what kind of, what essentially is going to be the big picture view when it comes to the hotel industry and the tourism sector. Now, before I start the interview, I'm just going to take the clock back. When it comes to our corporate interviews, we always like to take the clock forward rather than back, but I like to take it back. Indian hotel has been a success story. It has been a story where grit and survival was its theme, and customer satisfaction is, I think, right at the core. It's a story where Mr. Chatwal has managed to really navigate the ship at a tough time like COVID, and today, from being an ugly duckling, Indian hotel has actually become the darling of the stock markets. Everyone is just saying that, okay, what else can you do? How can you surprise us? So how can the management of Indian hotel surprise us after 7 or 8 quarters of a pleasant delight?
Yeah. Thank you, Nikunj. This is 6th consecutive record quarter, and so the last quarter was the same, better than the Q2 last year, and I think we are on a good wicket. As World Cup is going on, let's use some cricket terminology. It's a good wicket, and it's a wicket to play on the front foot.
Okay, you are playing on the front foot, but the problem is that the pitch can still be challenging. And the challenging pitch essentially is the environment. The corporates we've spoken to of late, they are of the view that just when they were ready to accelerate, global macro concerns have come back, especially for the tourism sector, especially for the travel sector. Could that be a disruptive factor in your peak quarter, which is the current quarter?
I don't think so. I think what we have to do is avoid unforced errors. And you can still bat on the front foot. And very importantly, I think there are always macroeconomic factors, which is geopolitical in nature, which is a pandemic like we had. Something will keep happening, and will keep happening at a very consistent pace. But our change in the business model has helped us do a couple of things. One is we have created new businesses which are significantly higher margin and no capital investment, like the ginger, ama, cumin. And we have used comprehensive asset management to reposition our iconic assets, not just only for being iconic, but to create more and more profitability on a per square foot basis. So our renovated Taj Mansingh today is extremely well positioned to do as well as it did before the extension of the lease, which came at a very high terms or at very difficult terms. Our ongoing renovation in Land's End, our addition of private membership club. Last week we opened the Chambers in West End. We renovated the one in Land's End. In our flagship, the Chambers will start undergoing renovations in a few months from now. So Chambers is an example of high margin businesses, and iconic assets like Taj Land's End today has an auditorium called Spectra for viewing of movies, for watching World Cup, booking birthday parties for kids. So I think all these factors, instead of saying you are asset heavy, wow, asset heavy is an opportunity because you decide what can be done with your asset. And as long as you're not making unforced errors, as I said, is well thought through, well calculated, all these assets, the absolute returns would keep going higher and higher.
So let me rephrase my next question rather carefully, and I'm going to take a leaf from what you've been indicating to our viewers and to our shareholders, that you expect that the uptrend in the hotel cycle could be a multi-year trend. So if I say for next 3 to 4 years or 4 to 5 years, the occupancy rate could be in double digit, the room additional rate hike could be in double digit, but the capacity addition would be in single digit. Will that be a fair assessment?
I think you have very carefully articulated that, to use your words. I think that's absolutely right, because I've gone on record saying the investment of the government in infrastructure has a positive correlation with the demand in hospitality. Be it roads, be it high-speed trains, be it 80 new airports, all these new demand generators, when they come in the market, they'll fuel growth in supply, but in new markets. Whereas the old, robust top 10 markets will see not that much increase in supply. At the same time, among the old robust markets, your number one market is Mumbai. Number two is Delhi or Goa. But look at what has happened in Delhi with the addition of Bharat Mandapam in Pragati Maidan, with the addition of Yashobhumi in Dwarka, with the addition of Jio in Mumbai. Whenever any event happens, let's forget G20, that was like, let's say, a one-off. Whenever any major event happens, which can host up to 3,000, 4,000 people in a single hall, under a single roof, what kind of demand it will create in that city? And are we well positioned on the supply side to cope up with the demand? In the short term, the answer is no. So I think there will be events that will keep happening thanks to this new infrastructure. The second is the consumer shift in behavior. You know, a lot of people are now driving themselves on extended weekend. And that is a trend that emerged post-COVID. So I think that is giving additional domestic boost in terms of occupancy and revenue. The third very important factor is that our GDP growth is at 6.5. And with a bit of luck, if it could go higher, that would create higher per capita income, which would increase the discretionary spend, which will obviously go to the restaurants and hospitality or airline sector. And we hope to be, or other luxury good items, but we are a part of that beneficiary group. And all the gurus and the pundits, they say that India is expected to grow the fastest till 2030 for sure, or maybe for several decades to come. So I think that has a direct correlation with average rates, with hospitality rates, occupancies, etc. And I think for the first time, it took 75 years. There was a little period of 2004 to 7 where hospitality was in a good space, but now since last 6 quarters and for several quarters to come, I think the hospitality sector stands in a very good space, and we being the largest in India in this space should benefit the most.
So 2-3 years, the cycle is looking good and great. That would be a message to our viewers.
No, longer. This is not a 2-3 years. We are already 1.5 years in the cycle, but because of the demand and supply situation, I think this is going to be longer, as during COVID, not many new hotels went under construction. Whatever has happened post-COVID or is happening is the completion of what had already commenced. And I think there is a new order that will come in terms of supply, in terms of consolidation, which keeps happening. Is not anything new. It keeps happening all across the globe. It will also happen in India. And because of that, this time, the cyclicality will still be there in the business, but the length of the cycle should be much longer than another 2-3 years.
Fantastic. Now, the current quarter, which is the October, November, December quarter, is always the bumper quarter. And I distinctly remember that when you came out with your numbers, I think it was the budget day, and the numbers were completely out of the park. It's like saying that aapne 6 mara tha, Yorker pe 6 mara tha. So assuming that what you've delivered for the quarter gone by, 20% plus growth, almost 20% growth on a standalone basis, 15-16% growth on a consolidated basis, are we in for another bumper Q3?
Well, the good news is today being almost the end of October, we have had an unusually strong October.
Unusually strong.
And
what is your definition of unusually strong? Top
line growth, which is high double digits, 10, 12, 14, 15, 16. No, we're talking more like a closer to 20% growth across the sector. It was wearing my other hat as the president of Hotel Association of India. We do have these discussions in which direction the sector is going. So October has been strong because of the way Diwali is this year. It's almost in the middle of next month, so 5 days before Diwali and 5 days post Diwali, usually the business slows down.
Okay.
But when we look at the pickup trends and how we are picking up business on the books, it is as strong as last year. So that means November, if it holds on like this, and October is very strong, then I do believe that we are in for a very positive Q3 far more positive. Let me put it straight, far more positive than we saw last year.
Okay, is 30%?
Weddings are not going away.
Yes.
Till 19th of November, World Cup is not going away. Christmas is still going to come. New Year is still going to come. Other festivals in other religions are also going to come. So I think we are in for a very good Q3 too.
Perception in the market is that, okay, the hotel industry just about got lucky because there was G20, there was World Cup. Next year there would be elections, which means that there could be delay in decision making. Big events obviously will not be there in and around election. Is that a concern? Is that a valid risk?
Not really. I think it's very difficult for people to believe because of the volatility in the business that this could be a sustainable, profitable business. I think that's the real concern, right?
Because you've never seen such a long good period. अच्छे दिन इतने लंबे देखे ही नहीं.
देखे नहीं. So when the landscape changes and you are well positioned to take benefit of that change, I think most important is to recognize those macroeconomic factors that could positively influence the sector. And I've always said it, I still maintain the demographic dividend of India stands to benefit immensely if this sector keeps booming. The tourism, the hospitality, the aviation, because the direct jobs and the indirect jobs, the multiplicator impact of jobs is significant. Elections can come and go. I think it's good for the country and is good for everyone to have employment. And the more the people are getting employed, the higher will be the GDP growth, the higher will be the spend locally in the economy. And definitely, we are in that very good space. Of course, there'll be some headwinds. Of course, there'll be like a warning call came from US for travel outside of the US, right? It'll come and it will go. It is not going to stay long. I always used to give an example when I was living outside of India, 9/11, and I was working for an American company. When I used to travel to the US, planes were empty. So you could have all the possible seats that you wanted to have. It was the next time I saw that was in COVID. And it took a few years for the sector to bounce back because people were worried as planes could hit World Trade Center, right? And you had no chance of survival. Then came the Madrid bombing, then came the London bombing, then came, every time the impact kept getting as bad as it is, it kept getting shorter and shorter, and it became restricted to a few days. So unless there is a kind of a black swan event, I think these headwinds will come, but they will also go away quickly.
Let me put the maths here. Now, you shared a vision statement of 2025. If I put the maths, if I look at the margins, the growth, looks like you are 1 year, you would be 1 year ahead to achieve whatever you indicated for 2025. Simple maths, margins, outlook, growth.
I wish everything would work on maths. So mathematically speaking, yes, that would be right. But practically speaking, something unknown keeps happening. So that's why we give a guidance over a business cycle. I think for a company that used to do on an average between 2008 to 17, 13, 14% margin, if we achieve 33%.
Is 30 the normal now for Indian hotels?
I think so. It's not because we are not focused on just one brand and one business. It's several brands, several businesses, and as I said, comprehensive asset management and the new ones driving the margin growth.
There's a time when we were asking you questions on your debt. Now that cash flow and free cash flow has started generating, the next question would be dividend and buybacks. I mean, I'm so happy that I'm asking this question. I mean, who would have thought that, Indian hotels potentially could have a balance sheet where the dividend could go higher and buyback could increase. You're already buying subsidiaries. I can see that. Could that be a path on which you would walk now?
We'll remain guided by the board. We'll have those discussions. I think the first half of the year is very different than the second half. Always, traditionally, the second half has been the strongest. And if the Q3 goes as you and I just discussed now, we will have a variety of discussions. It could be in organic growth, it could be on dividend policy, it could be on, simplification. Anything is possible. If you have the positioning and if you have the cash, of course, you can go for, as I said, avoid unforced errors, be opportunistic, make use of the capital you have, make use of the balance sheet you have, and that would come, if that was to come, would come over and above the guidance that we have given of opening 2 hotels every month. So that is like opening 70 plus hotels over next 3 years. And these are all which are already signed, legally announced, declared, and are happening as we speak.
So for next 1 year, irrespective of the election cycle, your view is that for Indian hotels and for the hotel industry, the pricing power and the demand trend will remain intact. But for Indian hotel now to take a giant leap, not just a small baby step forward. The internal repair of the balance sheet has happened. You made your company asset light. New businesses are getting incubated. But given that the Tata Group per se is now coming back in growth mode, how would you define growth from here?
Well, growth is not one dimension only. It's not just in the number of dots on the map.
Yeah.
I think, as our chairman would define it, one thing which Indian hotels should never forget is the normal growth which we are doing, the organic growth and adding assets all across India, 125 plus cities, with opportunistic growth, with management contracts outside of India with the Taj brand. Very strong focus on the Indian subcontinent. That means, Sri Lanka, Nepal, Bangladesh, where we also recently announced 2 hotels in Dhaka. All this will remain important, but the signature assets is the term he used, which I really like, is something that made our backbone, which is the Taj, an iconic brand. And we...
Well, it gives me great pleasure now to bring on board on ET Now, Mr. V. Vednathan, the man of the moment, to talk about how things have transpired for IDFC, First Bank, for the quarter gone by and what lies ahead. The year 2023, in a sense, will be remembered as a year where markets really realize the potential of this franchise. The stock has been one of the best outperforming stock in the entire financial space. So what's the way forward after another quarter of solid growth? Mr. Vednathan, you've ticked all the boxes if I look at the growth. Top profit growth 30% plus, deposit growth 30% plus, NIM growth 30% plus. So 30% seems to be the new normal for IDFC First Bank. But my question is that as you grow, your base also increases. Can you maintain this run rate of 30% plus for next 3 to 5 years?
Very interesting that you brought in a new angle of 30%. Really, we didn't think about it like that. The way we think about it to looking ahead, we think that a loan growth of about 24-25% is what we guide for. We think that's very much achievable even for this year. And profit and deposits, by the way, as soon as a foundation for any bank, because that's the raw material. The really good news for a bank, this raw material that's growing thick and strong for the bank, that's up like 44%. So I think this is very much sustainable for the rest of the year. If not 44%, let me say 40% is looking, the route is looking clear to us.
So how will you manage to beat the base effect? Could it be because of the pure expansion of the book? Or you think it's the tailwind in the sector which is so strong that at your base managing this kind of a number is not a problem despite the high base?
It's not a high base, first of all. When you see the big banks, like, the big 4 banks, they are running deposits of 18, 20 lakh crores. Our deposit base is only like 1.6 lakh crores now. So we feel that we are relatively a small base. And for a small base to sprint ahead at this rate is very much possible. So basically, since a branch network has rolled out, our brand image has become very strong. Nikunj, actually very, very strong. Of course, not in the league of the big 4, but let me say it's quite strong. So a good brand, good product, a good corporate governance image, all that will bring deposits. We feel confident for the rest of the year. And incidentally, we dropped interest rates to just 3% for less than 1 lakh rupees. Money was flowing so thick and fast into the bank.
The net interest margins remained steady at about 6.3%. They were steady at a time when peers have reported a drop largely because of the interest rate curve. Going forward, now that interest rates are becoming benign, what happens to your net interest margins?
we feel it will be stable for the rest of the year, Nikunj. We don't see a major problem with that.
And do you see on the deposit growth also the 40% growth what you just referred to, because of the brand you've built, the customer, the number of satisfied customer, you will be able to grow your deposit base at 40%, given that there is still a war of liabilities in the Indian banking sector?
That's what I was pointing out. At least for this rest of this year, things look quite clear. We feel confident for the next year also. 24, 25 also we feel confident about keeping sustaining a strong deposit growth. Because even in 24, 25, our base will still be small. I think there is a base effect working in our favor, and base being low. And I think for the next 4 or 5 years, our base will continue to remain low when you compare to the big banks. Then probably things will stabilize. And frankly, we don't need deposit growth at 40% after 2 or 3 years. Because since the loan book growth is only 22 to 25, you don't need 40. You need 40 only for 2 more years, when we are going to pay off those legacy infrastructure bonds. We need to honor that, and we need funds for growth. So this 40% needed only for a couple of years.
The way I look at IDFC First Bank trajectory is that first it was in repair mode, now it is in growth mode, and now the benefits of operating leverage would kick in, which is that sooner than later your cost to income ratio will start coming down. That will fill up your profitability going forward. When do you see that big turn happening? 2021 was repair. 2022, 2023 was about growth. Now perhaps the benefit of scale and size should come in when it comes to things like cost to income ratio.
Yes, very much actually. The first 4 years, 3 years, let me say, we've been here post-merger close to 5 years now. But let me say the first 3.5, 4 years are repair only actually. But last 1.5 years, we are feeling very strong on the foundation. Let me say we built the foundation. On this foundation, we're feeling very confident to grow the loan book by 24, 25 and grow the deposit by, the numbers we talked about. When you look ahead, the key thing on cost to income is that actually even this year itself, we were expecting some sort of a dip. But as you know, interest costs went up in the system overall by a meaningful number. To that extent, our interest cost went up, and therefore the cost income ratios, etc., all these things got affected. Because when you have cost to income, the income you take net income, net of interest cost, so it got affected. So by next year, let me say by exit quarter of 25, we should see a more meaningful reduction. And 26, 27, 28, you can see that this story will play out very well. I just wanted to remind you that we had like 5 years, converting from a DFI, large DFI to a bank. So in that sense, the progress has been pretty swift at the bank.
One chink in the armor, if I may say, fly in the ointment is still ROA. It is not way below your guidance, but it is still below your guidance of 1.4%. When will that surprise factor kick in?
Definitely, it will improve in due course. I can't claim it will increase every quarter because, life, business is the business, and, one quarter can be up and down. But when you take year on year, when you take 24 over 23, meaning 23 over 22, 24 over 23, 25 over 24, 26 over 25, the bank will see a continuous increase because we have set a very core model. As you know, we are not hurrying it up. We are playing this game in a very safe and stable manner. And when you play in a safe and stable manner, sometimes you take time, but it becomes more sure. That's the approach we have. But you will see year on year, you'll see improvement now. And by the way, it's moved out from literally from 0 to 1 in 4 years. It's pretty healthy now, and we feel better.
No, it is healthy indeed, but the growth what you've reported in a sense are making markets and your shareholders perhaps hungry for more. That is the spirit of the market. So my next point is that you raised capital in the quarter gone by. Banks, when they're growing, yes.
No, I said that's the spirit of the market, but it's my job to calm down everybody and not to get too excited. And we are playing for a steady innings, for a long innings. And I really request people not to expect miracles, not to expect like quick work. Bank is doing a steady job, and steady and sure job is much better than quick and whatever.
How much importance, honestly, do you pay to the stock performance? Because for banks, when they're growing, they need capital. When they need capital, they tap the market, and which is what you've done. So, in the overall scheme of things, for any growing bank like yours, there is need of capital, which in a sense is serviced by equity raise, and for that you need a you need a good price. How much importance do you pay to your stock price?
See, the way we look at it is that if we do the fundamentals right, somehow the markets do recognize that. If you notice today, even today, our return on equity is not that high when you compare to many of the peer banks. We're still on the build-up stage, but market is valuing us relatively better than our return on equity today. So we do believe that a safe and steady job with a clear picture thrown out for the future, markets do appreciate that, and it is reflected in reflected in us. I agree with you. But the more important thing is that we are well capitalized at present concept. That's very important. Our capital is running at 18%. So we are well set. And even if you have like markets are markets and war and all these things going around, even if there's some bit of turbulence, we will be very safe because we have enough gas in the tank with 18% capital adequacy.
So, Mr. Vednathan, the fact that you've just done a small round of capital raise, do you think you've just raised capital because capital was available and it was there to on the tap, or you genuinely need capital? Because the growth right now is so strong that even if you plow back your profit, you really genuinely don't need capital.
It's not only because the markets are giving, which they are today. The good news is that, like I said, in our case, when we wanted capital, we touched the market, we got 3,000 crores. So, and so markets have confidence in us, for which I'm really grateful to the markets. The more important thing is that as a well-governed bank, to be overcapitalized is a good thing. And it gives gives us, our board, our risk management committee, it gives a lot of comfort to our board. Our board is a very conservative board, and they just want to be sitting on a lot of capital all the time. And I feel the same way as well.
So if you have to divide, let's say, the trajectory of the bank in three pockets: short term, when I say 1 to 2 years; medium term, 3 to 5 years; and long term, which is 5 years plus. Can you give us a sense of the roadmap? Short term, medium term, long term.
A very good question. Let me talk long first. In terms of long, I once did a quick work about the Indian market on the three businesses: retail business, MSME business, and the agricultural business, rural business. This market today is $1 trillion. If we just did a reasonable assumption of growth, in 20 years, it should be $15 trillion. And when we did our growth, you won't have to take my word for it, but we guessed it at, say, 20% for 20 years. It could be 18 also, it could be 15 also. I want to leave the caveats open. But if we did that, we found that, the loan book could be, any number. I don't want to say the number also. It looks really so high. It looks like a multiple of 35 plus. So that's the kind of growth opportunity available. So we are always focused on that. I know quarter numbers are good, but we don't get excited by that because our eyes are there. In the medium run, I'd say that we should focus upon building the bank in a stable manner, manage all these headwinds and economic situations, and post a decent return on equity and return on assets. In the short run, we should be very, very, very focused on managing our credit quality, and particularly with the messages going around in the environment, etc. Global environment, not India. We should be very particular on asset quality.
But given that right now Reserve Bank of India once again has raised concerns about unsecured loans, as in banker, do you think there is a concern coming there? I mean, is there a bomb ticking somewhere, or right now you don't see any problem whatsoever, at least on the unsecured part?
What we have done is we have tightened all our credit norms. We don't want to get complacent from the fact that we've never had a credit problem. For 13 years, our gross NPA has been 2%, net has been 1%, and credit cost has been very low. We take confidence from that. but we don't want to be complacent. So we have tightened all our norms just to be extra safe because we heed the concerns and they are important concerns.
That's IDFC's first V. Vaidyanathan chatting with us and talking about how their earnings are likely to pan out going forward and, of course, what the quarter went by was like. Max Estates, let's just mark that listing. Remember, it's a reverse merger between Max Ventures and its subsidiary Max Estates. That's listed at a discount to its issue price, 5% lower for Max Estates as we speak. Right now, it was, however, successful conclusion of the reverse merger that took place right now. Earlier, remember, they had two business segments and that reverse merger took place, and that's the newly listed entity right now in trade at a price point of 283. On that note, we're going to take a very quick break.